Good morning, y'all. I want to take a minute to go over a few terms. So, I'm speaking specifically about investing. When you hear someone say they're going to have interest or make interest or whatever about interest related to investment, what that means is that they have invested in something that has a guaranteed or variable interest rate attached to it, and they're going to receive that percentage of interest for their money, right? So, what that generally means is that you've invested in a CD or a high yield savings account or a treasury bill, something that is a very safe investment that is going to give you a guaranteed rate of interest back to your money. This could be called your rate of return, but it's locked and kind of fixed in based on the percentage, 5%, 3%, whatever interest you've been promised. This is a little different than the rate of return that you're going to get from stocks or mutual funds. So with the interest for CDs and high yield savings accounts and treasury bills, that's a locked in thing. There's not really a risk involved. But if you're investing in stocks or mutual funds, the underlying asset or the thing that it's tied to is not the US government or something safe. It's tied to a company, and that company and their stock goes up or down. So if that underlying asset, the stock related to that company, goes up, then your rate of return, what you're going to earn from owning that stock, also goes up. That's your return. It's not fixed. You have no idea what it's going to be over a particular rate of time or period of time. In a CD or a T-bill, there's generally some kind of term. You know exactly how long you're going to hold it. It's a safe investment compared to your stocks, which are variable. You don't know how long you're going to hold it. You don't know how much it's going to go up over time. All of these things are unknown, and that's what makes it risky. That's also what makes you be able to get more of a return. So if someone tells you that you have a locked in, can't lose your money investment, either they're lying or it's just tied to interest, an interest rate, and you're only going to get that interest. But if someone tells you you're investing in something else that doesn't have an interest rate attached, then you're investing in a business or a stock or something that there's high risk and also high return. So I just want to make sure that when you're thinking about where you're putting money, you understand how you get your money back. Either you're locking it in and tying it to interest rates, or you're tying it to a company or a business or something where there is no guarantee. That's it. That's all. I just wanted to share that. I'll talk to you later. Bye.
I realized in that last video I wasn't particularly explicit. So let me say this. For those life insurance policies that you all love to buy, the annuities that you love to buy, all of those different instruments that someone is trying to sell you, when they tell you that there is a guaranteed return or you can't lose your money, ask them how. Ask them if it is based on what the rate of return is based on. Is it interest? Is it tied to something else? What is it tied to? What is the underlying asset? Is it tied to the stock market? Because if they say yes, then you know it's not guaranteed. The point is, they sell you these instruments, and I want to make sure that you all know the instruments have to be tied to something. The returns, what you make, has to be tied to something, and I want you to understand what it's tied to. Then call it a life insurance policy, call it an annuity, call it whatever these things that they're selling you are, but know how they make their money. That's it. Talk to you later. Bye.